and maybe their Airbnb rentals aren't as strong as they once were, so they're trying to figure out if they're going to sell.
If you are a taxpayer who owns real property,
and this topic of 1031 just keeps coming up again and again.
A tremendous amount of things that the taxpayer really needs to pay attention to, have conversations about, and work out. Why not preserve that equity?
Here with me today, I've got Matt Linville. Matt, you're the Vice President of Marketing with Investors Title, correct?
That is correct.
And today I asked you to come and spend some time with me today to talk about 1031 exchanges, because it is such a common thing that's been coming up lately. I think what happened in, COVID, and you can probably speak to this, is so many people went out and bought vacation homes. They went out and they bought investment properties. They took advantage of the low rates, and now they're sitting on all this equity, and they're trying to decide, what do I do? Do I keep the house that I've got? Some of them are Airbnbs, and maybe their Airbnb rentals aren't as strong as they once were, so they're trying to figure out if they're going to sell or whatnot. And this topic of 1031 just keeps coming up again and again. And it's come up with a few friends of mine personally. But I feel like it's this thing that everybody knows is out there, but doesn't really know how to go about it in the right way. And one of my clients that I sent to you pretty recently, had he continued to go down the path that he was on, 1031 wouldn't have been an option, because he would have gone too far into the process before starting. So all that is to say, I think that the market needs an education in what a 1031 exchange is and how to properly do it. So having said that, you're the expert. Why don't you tell me, in your own words, what is 1031 exchange?
Well, Chris, wonderfully, over 100 years ago, the IRS included language that leads to 1031-like kind of exchanges. So this is something the IRS has allowed us for over 100 years, which is absolutely amazing. Now, there's been a lot of iterations over the years. It's changed and morphed here and there, but today what we have is this: if you are a taxpayer who owns real property, and you've held that real property for investment and or business use, when you sell it and you take those proceeds and you roll that over into other real property that, again, you'll hold for investment or business use, then the IRS will not make you pay the tax you would normally pay on the gains immediately. So they allow us a deferral. And Chris, this is kind of the way I look at it. We're just through tax season, and whenever we file our taxes and we find out that we're getting a refund, it's like one of the most exciting things in the world, right? What am I going to do with this money? Where can this go? And then there's the moment of clarity where we realize they're just giving us back
our own money.
That's right. And Chris, how much interest did they pay us while they were holding those funds? Zero. That's exactly right. So I kind of look at 1031s in the same way. Whereas the IRS had our money, they paid us back later with no interest. In a 1031, the IRS is not making you pay immediately the tax you would normally pay. So we get to keep that. We get to reinvest that into additional real estate or additional properties to increase our real estate portfolio. And in essence, we have to pay zero interest to the IRS for keeping our own money for a period of time. So I think that is the beautiful piece of it, is why not preserve that equity that a lot of your friends that you mentioned and a lot of our clients, they sit around the table and they worry about it. They cry over it. They get angry about it. It becomes a commonplace, conversation about who's going to be there when this needs to be repaired, or who might have to go to court for these reasons, whatever it may be. All of that blood, sweat, and tears that went into that property, if possible, why would you not preserve that and utilize what the IRS has freely given us, which is the ability to reinvest it without immediately having to pay tax?
Okay, that's a great summary. So just to kind of dive a little deeper on some of the things you said for the layman out there. So if you're selling a piece of real estate or real property, and it's your primary residence, the IRS allows you to make some money on that personal residence up to, I think is it 200,000 per person and 400,000 for a married couple?
So for that section 121, that primary residence exclusion, it's $250 for a single and $500,000 for joint filers.
Great.
Yes, so and that's an exemption, no tax whatsoever.
No tax whatsoever.
Mm-hmm.
So if you're living in your own house and that house has appreciated 250,000 if you're a single person, or $500,000 if you're married, and that's your taxable gain, then you have no tax that applies to that gain, and you can then take that I'll call it profit, whatever you want to call it, and roll it into whatever you can spend it. It's not taxed. But with an investment property, it's different. So a house that you don't live in, or maybe a house that you used to live in but no longer live in, and you see that a lot in the market too. People buy their first property and then they move into something else, but they keep that old one and turn it into a rental.
Right.
And now it becomes an investment property. And once you get outside of that, you have to live in it 2 out of the last 5 years in order to qualify for that primary residence exclusion. But once you get outside of that, now it becomes a taxable property in the eyes of our IRS, right? So in that event, now you have that gain. And if you were to sell that property, you would pay what kind of tax on that gain?
So typically when we have somebody who's selling an investment property, you're looking at 4 different taxes. First, and of course the most well-known, is the federal capital gains. And that's either going to be 15 or 20% dependent upon the taxpayer's income. Mm-hmm. So that's number one. Number two, in states like, of course, North Carolina, South Carolina, Virginia, we have a state tax outside of those living in Florida and Tennessee and Texas and others which do not. But the 1031 also defers potential state tax. And so you're going to have a range from 0 to 14% that can be deferred from that state level. Next, there's a net investment income tax dependent upon income that is 3.8%. And then there's this fourth tax, and I'm not saying it's not relatively known, but it can be a significant portion of that sale depending on how long you've owned it. And that goes back to our depreciation recapture tax. So as the IRS is kind enough to allow us to depreciate our residential or commercial investment property X dollars every single year, at the end of that time when we begin to sell that property, the IRS says we're glad to have given you that gift of depreciation, but we would like, as much as we can tack back to the gain, we'd like to have 25% of the depreciation recapture back, or depreciation recapture. So depending on how long the investment's been on, how long it's been depreciated, that can be a very significant piece of that tax. So you're looking at a tax stack between 30 or 40% possibly that can be deferred through that 1031 like-kind exchange. And again, that 30 or 40% is what now you have the ability to roll into an additional property and hopefully buying bigger or more properties.
Okay, so let's talk about that term like kind. What does that mean? Can you take, let's say I own a house at the beach. Does that mean I have to buy another house at the beach, or can I buy a farm?
Yeah, so the like kind definition is one of the most misunderstood, but it makes sense in that, Chris, when I have somebody call and they say, man, I'm getting ready to sell some land, I want to do a 1031 and I know I have to go buy other land for it to qualify. And I'm like, well, you can buy land, absolutely. But that like kind definition is much more broad than it seems. It's literally any real property for any other real property. So if I am selling, a rental investment property at the beach, single family, I can sell that and go buy a multifamily. I can sell multifamily and go buy a car wash, sell a car wash, go buy a warehouse, sell a warehouse, go back and buy a single family rental. As long as it meets that real property definition, and as long, again, as it's being held for investment or business use, it should qualify. Now, there are times when we get into a discussion about real property, and let's just take, for instance, a boat slip. Sometimes a boat slip is real property. Sometimes it's personal property. When we're working with folks who are selling mobile home parks, it's important to know out of the trailers that you have in the park, which are considered personal and which are considered real. Does it still have the tongue on there? Are the wheels and axles still on there? Has it been removed from the DMV registry? All of these things are important to know. Am I selling real property or personal property? And if I need to have an appraisal to make sure of what's real and what's personal, what value should be attached, that's something certainly that should be done. But again, back to the original question, Chris, it's so very broad in what is possible in a 1031. And I think sometimes people limit themselves initially to what they think they can do until they talk with, agent, broker, with the CPA or attorney, or certainly with a qualified intermediary to get better clarification of what is allowed and what's not.
Okay, that's helpful, but I agree. I think that's one of the most misunderstood things. I think there's an assumption out there that like kind means, what you would think it would mean by its own definition, like beach house for beach house, farm for farm. But that certainly opens up a lot of possibilities for people.
Right. It's like you said, they're not wrong. They're just not as right as they could be.
They're just not fully right. So let's say you've got somebody out here who's thinking about doing this. What would be, I'll ask this question in two parts. What would be the proper first step to take? And what would be the step that they could take that might disqualify them from this tax exemption?
So, Chris, number one is to please consult their real estate attorney or their CPA regarding the property they're wishing to sell. And the reason that I say that is if you were to ask people what the basis was in their property they're looking at selling, they may not know. They might remember their purchase price, but that's not necessarily the basis. So I would go back certainly to my CPA or accountant and say, listen, if I sell property A, what's going to be my tax bite? And are there any losses or anything else in my larger tax picture that may eat up some of the gains from that property, at least the tax from it? So they have a good, clear understanding of what the potential tax is and how much they could defer. I think that's step number one. Number two, I would talk with their CPA or real estate attorney to make sure they've held the property for the proper amount of time and for the proper use. That really needs to come from their real estate and tax advisor to make sure that property qualifies. Number three, Chris, they need to talk to you. They need to talk to their agent. They need to talk to their broker and tap into your expertise on what what's the possibility of selling, what might that price be, and what other suitable properties might be in that market or in that asset class that they may strive to purchase through their 1031. And lastly, I would say, whether it comes from you, Chris, or from their CPA, they need to talk with a qualified intermediary ahead of time. What I always say is this: though we cannot provide tax or legal advice to the taxpayer, what we can do is help them avoid some potholes or keep them out of the ditch and say, listen, when you go back and you talk to your CPA or attorney, here's the 2 or 3 things you may really want to cover and talk about and get some clarity on before you think about proceeding on the 1031. My standard statement is this: I don't believe that taxpayers are as friendly to themselves as they should be. And I know things happen last minute sometime, but I think taxpayers, especially if they have surrounded themselves with good, advisors and professionals, tap that knowledge early so that you can go ahead and begin to put a plan in place. Sometimes what we want to do and what the perfect scenario ends up being, it takes time to accomplish and to do. It can't happen last minute. So I think it's good to go ahead and talk with all your professional advisors, get the qualified intermediary involved early, have those conversations. I think that's the most important thing. From my years of working in this, I don't think any taxpayer would look at me and say, Matt, I took too much time to think about it.
Sure. Yeah.
So I think that's number one. And certainly that qualified intermediary, and a lot of people, Chris, will say, well, Matt, what part do you play and why are you even involved in this at all? And the qualified intermediary is that necessary third party in this 1031 like kind exchange that really creates and preserves the opportunity for the taxpayer to enjoy a 1031. And the reason I say that is the qualified intermediary needs to have an exchange agreement in place, signed and dated by the taxpayer, at least at the point of closing table. Okay, so they need to close with an exchange agreement signed and dated in place, ready to go for that client. That gives the IRS the indication that they are going to complete a 1031.
Got it. Okay.
What are we trying to avoid? We're trying to avoid constructive receipt. One of the saddest calls, Chris, is when we get a client, they'll call and say, Matt, I want to do a 1031. I'm like, fantastic. When are you closing? Well, we closed yesterday, right? So I'm like, okay, do you mean that you signed a contract yesterday, or were you at the closing table? Well, Matt, we were at the closing table. We closed. I have a check in hand, but I haven't cashed it yet. Unfortunately, it's too late. They really needed that exchange agreement signed and dated by closing to make sure they had a 1031. Now they've touched the money and they no longer have an exchange. So that's crucial. I mean, it is one of the most crucial things as far as the 1031 goes. Have that conversation with your QI, get the exchange agreement in place, signed and dated before closing, to make sure that that money flows from the closing attorney's escrow account directly to the qualified intermediary. Doesn't pass to the taxpayer, doesn't pass go, collect the $200 kind of thing. So they don't touch it. And that will preserve their at least initial ability to transact 1031.
Okay. And let's follow that example for a second, a little deeper. So in North Carolina, part of most real estate transactions involves a deposit that goes to the seller directly. Does that constitute constructive? What was the term that you used?
Constructive receipt.
Constructive receipt. So if the seller receives a due diligence check, let's say from the buyer for $5,000, but hasn't closed on the property yet, does that receipt of monies constitute a taxable event?
It does not initially. So that taxpayer can take the due diligence money in, they can deposit whatever they need to do. However, what we suggest is at least, a couple of days before closing takes place, they call the paralegal and say, listen, I've got $5,000 and I need to wire that to your escrow account. I want that $5,000 as a part of the proceeds that goes to the qualified intermediary for my 1031. So just make sure it's to the closing attorney in their escrow account before closing, so it can be included in those proceeds that come to the qualified intermediary.
Okay. All right. So best case scenario, if somebody's considering doing this, first step is to do your homework, figure out what your basis in the property is, what your taxable gain might be, so that you can decide whether it's worthwhile to do a 1031 exchange or to just take the proceeds and use them how you please. Talk to a real estate agent, figure out what the property might sell for, which will further help you get clarity on that. But certainly no later than, I'm going to say, a week prior to closing on this property, you need to make this decision and engage a qualified intermediary to do the paperwork by closing and be on hand, ready to receive the funds from closing. And at no case should you take funds from the closing table if you think you want to do a 1031 exchange. What if the property has closed, but the seller has not picked the check up and it's just sitting with the closing attorney?
Yeah. So usually, Chris, so one of the questions that I ask agents when I go out and talk with them is, have you ever been a part of a 1031 transaction with your client but didn't know about it until closing? And the reason I ask that is a lot of times on those closing documents, if a 1031 is involved, you'll see the seller as Investors Title Exchange Corporation as QI for X, whoever that entity is selling. And then in the dispersal part, you'll see 1031 proceeds to Investors Title Exchange Corporation as QI X amount. And so there's some assignments that need to happen. That exchange agreement again needs to be signed and dated by closing. And if closing has already happened and those things aren't in place, then it would be very difficult for that taxpayer to pull off the 1031. Now, have we seen closings reopen? We have seen that. But Chris, you know better than I the risks of reopening a closing and what that other buyer and or seller may or may not do if that transaction is reopened. So again, complications that don't necessarily need to happen. Now, have we had people at the closing table who said, wait a minute, I think I want to do a 1031? Absolutely. And after the paralegal has, ran their fingernails down the table going, oh my goodness, we can say, listen, take an hour, go grab a cup of coffee, and we can have the documents and everything in place for you in about an hour. That's the easy part on our side. It may be more difficult on the closing side of the table. Right. But anything you can do to make sure it's there. Now, if someone were to call Chris and say, listen, I closed yesterday, can't we just go ahead and get the exchange agreement in place and just backdate it? No, because I like to sleep at home. I like being at home and not in prison. So we don't like to commit any type of fraud. We don't like to backdate a contract just in the same way, Chris, you don't like to backdate a contract. It just shouldn't be done at all. So make sure to meet that deadline. That's the most important thing.
Okay. So let's talk about the other deadlines, because if somebody goes and does this, there are some deadlines on the back end of this process, right? Once they sell, they have a certain amount of time to identify and then close on the next property. So talk to me a little bit about what that looks like.
Sure. So let's go back to that day of closing. That is when 2 time clocks are going to begin ticking on that same day. The first one is that 45-day exchange period, or 45-day identification period. Sorry. The taxpayer has 45 straight calendar days to identify potential replacement property, typically to the qualified intermediary. So again, those 45 days, weekends, holidays, rainy days, Mondays, kids are sick, we're on vacation, just don't feel like it. All those days count in that 45-day calculation. So in those 45 days, they need to be proactive in finding the property that they feel they could potentially close on. Now, if we're waiting on a check for 45 days, it can seem like a long time. When you're trying to identify property in 45 days, it can go by rather quickly. So aside from what the qualified intermediary will do for the taxpayer, meaning we'll call and say, listen, you got 30 days left in your ID, you got 15 days, you got 10 days, 5 days. As an agent or broker, knowing that your client has 45 days to find something, you should be the pusher as well, the encourager, to say, listen, I'm going to come by your house. I'm going to pull up your driveway. I need you to get in the car with me, and we're going to go look at some properties that may fit for, your potential identifications. If you know the strains and the pain points of your client, then you can better serve them and help them in trying to find those proper properties for them and their potential replacement property. So again, that needs to happen within the 45 days. If the taxpayer has no property identified by midnight of the 45th day, on day 46, their exchange is over with. Money will be returned to them just as if they never attempted a 1031. Okay. Now, here's the cool thing in that 45-day period, especially in times when inventory is low, competition is high, okay, that identification during the 45 days is fluid. So if on day 2, you find them a property, they identify it. On day 30, you find out property's off the market for a million reasons that it can be. They can amend that identification and go out and find other property and identify it. But we have to have something on record by midnight of the 45th day to make sure that they are able to then go into that 180-day overall exchange period. And again, remember that clock began to tick on the day that they closed on the property. So they have 180 days or until their tax filing due date whichever one is less, to actually close and take title to any or all of the property that they identified in that 45-day period. Now, 45 is included in the 180, so it's a 180-day total period.
So if they identify a property during that 45 days, then what you're effectively saying is after that, they have another 135 days to close on that property.
That's exactly right.
So what if you identify a property on the 45th day and then on day 70, it doesn't work out?
Right. So can I say this lovingly? The IRS doesn't care. For whatever reason that those properties may not be suitable for closing, or you simply can't close on them, the IRS doesn't care. Okay.
Yep.
Whatever you have identified by midnight of day 45, chisel it in stone. You have to buy at least one of those properties. That's right. You have to buy at least one of them. Now, the other question that I get, Chris, is, well, Matt, is there ever an extension of the 45 or 180 days? And there are, but there are things that need to happen that no one wants to happen. So typically it is a presidentially declared disaster, which is done on a county level, hurricane, fire, flood, those things that, again, we do not want to happen, right, which would then cause the Treasury or IRS to release potential extensions for those who live in those areas or who may own property in those areas if they're trying to effect a 1031. Outside of that, if I can't close on a property outside of those 45 days, I'm just stuck. Now, okay, here's kind of the rescue, Chris, as I see it. One of the most used rules when it comes to identification in those 45 days is the 3 property rule. We call it the free 3. So I can identify up to 3 properties in that 45-day period. And for identification purposes, the IRS doesn't care what those amounts are. So if I'm selling a property for $1 million, then I can identify 3 properties and their values could be $10 million. The IRS doesn't care. But for the taxpayer, it gives them backups. Yeah. So if I'm selling property A, identify property B and property C. Well, if I can't close on B, I still have property C identified, and maybe that's a property I can close on. So there is an ability to identify multiple properties. And so that's something that the taxpayer needs to be aware of. Their agent or broker that they're working with, they need to be aware of it so they can get as many properties identified as allowed and as the taxpayer is comfortable with, to give them as much opportunity to close on something within that 180-day period.
Okay, that's helpful. That makes sense. Gosh, there's so many boxes to check in this process, aren't there?
Yes, there is a tremendous amount of things that the taxpayer really needs to pay attention to, have conversations about, and work out.
As it pertains to the identified property, let's say the proceeds from the sale are $500,000 and your identified property is only $400,000. So you're going to have $100,000 additional, proceeds that aren't going towards this new property. How is that additional $100,000 treated?
So if I were to say to someone who said, well, Matt, what do I need to do for a full tax deferral? And very easily what the IRS told us was, okay, Chris, if you sell for $1 million, the IRS would like to see you buy for at least $1 million to get your full tax deferral. Fortunately, it's not an all or nothing. That's the great thing. So if I am selling for 5 and I'm buying for 4, perfectly fine. The $400,000 that goes toward the replacement property is up for deferral. The $100,000 that I'm walking away with at closing is up for taxation. Okay. The typical conversation that we might have with a taxpayer who says, either I'm buying down or I want to walk away with some cash at closing, is to make sure they talk with their tax advisor. And the reason being is there is a point, and of course it's different in every transaction, but there is a point where you can take out too much cash, or you can buy down so far that you're basically eliminating the benefit that you would gain from a 1031. So nothing wrong with taking cash out. Just make sure that you're not taking out too much, that at the end of the tax season, when they begin to file and report that 1031, that there's not as much or maybe no tax savings where they thought there would be some.
Okay. Yeah, that makes sense. Is there any other question I didn't ask that I should have asked about 1031 exchanges?
Yeah. So there's a lot, but I think the first couple of things that I would address is same taxpayer. Same taxpayer rule comes up a lot. And what the IRS requires in the 1031 is the entity that sells the property must be the entity that buys the property in a 1031. Okay. So if Chris is selling in his personal name, then Chris needs to buy in your name. If Chris is selling in Chris LLC, then Chris LLC needs to be the person that buys. That taxpayer ID needs to stay intact in that transaction. That's how the IRS is going to track.
Yeah, that makes sense.
That tax, yeah, absolutely. So that's one thing, and it really comes into play, especially when you have partnerships that are looking at potentially dissolving, or they're splitting, and a few want to do this and a few want to do that. That becomes a very important piece of the conversation that we would have with a taxpayer. Now, I would say one of the biggest things, Chris, is this. Somebody will say, well, Matt, how long am I supposed to own a piece of property before I can sell it in a 1031? And the IRS did not give us a number of days. What they said was your intent when you bought that property needed to be for business or investment use. So if you can prove that in 5 months, okay. If you can't prove that in 5 years, that's not so good. Okay.
Right.
But there's a lot of timeframes people have heard. You've heard 2 years. A lot of people will hear a year and a day. And 2 years, I'll tell you why we look at 2 years. But a lot of advisors will say you need to hold it for at least a year and a day, because I moved from short-term capital gains to long-term capital gains at a year and a day. And at a year and a day, I've held it in 2 different tax years. So you'll have some advisors who say that's great. Really, the question comes in, and what we know from the IRS is we have a safe harbor that was given to us back in 2008. And that has to do specifically with residential investment property. And going back to the very first part of our talk, Chris, when you were mentioning folks who had bought vacation homes or second homes, and maybe they used them personally for a bit and didn't truly treat it as an investment. Well, the question comes from them and says, well, how do I need to treat this second home so that it will now qualify for a 1031? So this is what the IRS said. They said, before you sell that piece of property and you want it to qualify for a 1031, first off, you must have owned it for at least 24 months. Okay, that's the minimum. You may have owned it for 10 years, but they're going to look at the last 24 months of your ownership of that piece of property. Okay, so that's number one, 24 months. 2, in each 12-month period, in that 24-month little cycle, you needed to have rented the property at fair market rent for a minimum of 14 days, each 12-month period. Okay. So you can certainly do it more, but at minimum, fair market rent, 14 days each 12-month period. 3rd, you have to keep your personal use limited to what the IRS allows, which is you have personal use of that property 14 days each 12-month period, or 10% of the time in which you have rented the property out, whichever one's greater. So if I rented the property out for 300 days, then I have 30 days of personal use of that property.
Interesting.
The end game is this. The IRS said, if you'll abide by those 3 things, we will not question how long you owned it or how you treated it. Okay. Yeah. Now, on the backside, so when we have folks who say, well, Matt, when I buy the investment property, when can I convert that into a different use? When can I convert it into a second home or a primary residence, right? And it's the same litmus test. That property that I buy, I need to hold it for at least 24 months. I still need to rent it for a minimum of 14 days at fair market rent each 12-month period. And I need to keep my personal use limited to what the IRS allows. And after that time point, at some phase along the way, I can convert it from a qualified use, which is treating it that way, over to a second home or vacation home or primary residence, whatever it may be. So again, there are ways of, okay, Chris, I'm at A, I'm trying to get to C. How do I get there? That's when your expertise comes in hand, their tax advisor's expertise comes in hand, qualified intermediaries' expertise can come into play and really help shape how they get from A to C in the most tax efficient way. And a 1031 can be a part of that.
Okay. So in summary, there's a lot to this process that I think that the lay person, including myself, I learned a bunch today, doesn't know. And so I think that my biggest takeaway is that if you're thinking about doing a 1031 exchange, plan it in advance and ask these questions and talk to the people involved, talk to investors title, talk to a real estate attorney, talk to your accountant, talk to your real estate broker. Make sure that you've got the qualification piece. That was a great ad. I mean, I didn't even think about that, but that could throw a wrench in it, right? So thank you so much for all this information. It's been extremely helpful.
Great.
Yeah, it's been great.
Wonderful. And you know, it doesn't cost anything to call your qualified intermediary, or at least it should. It doesn't cost anything to call us and have as many conversations or emails back and forth as you would like to have. Again, I would caution folks on the fact that as qualified intermediary, we are not allowed to provide tax or legal advice. And in summary, just let me say this. To be a qualified intermediary, that qualified piece is a little bit of a misnomer as well. To be a qualified intermediary means that we are not a related party to the taxpayer, and we are not an agent of the taxpayer, meaning we haven't provided any services in the last 2 years for that taxpayer. And so they may say, well, can't my attorney or CPA or agent or broker, can't they serve as qualified intermediary? Not if they've done any work for you in the past 2 years. So that's good. But literally, Chris, you could walk out of the studio right now, go to the street, stop the next car and say, hey, will you be my qualified intermediary in a 1031? And if they're not related to you and they're not your CPA or attorney who's done work for you in the past 2 years, they can't. So qualified doesn't necessarily mean your best option. So anytime they're looking at a qualified intermediary, you know, I would want to know how long have they been in business? Give me an estimate of how many exchanges you handle per year. What's your fee? Do you pay interest on the money while you hold it? How are my funds held? Are they secure? When you wire funds out, are you going to get my approval? How are you going to do that? What type of policies do you have in place? E&O, anything else that you may need? And, you know, what are the experience? What's the experience of the people who are handling my transaction? Are you attorneys? How long have you been doing it? These are the things that I would ask, Chris. When I do a 1031, I can't use my own company. So I have to use another QI. And so those are the things that I'm asking. And I hope that every taxpayer would ask anyone who they might consider serving as their qualified intermediary.
Yeah, that's great advice. So the guy in the car on the street might be able to be it, but you wouldn't necessarily want that person to be.
You might not want. They can also perform surgery. You may not want them to, but they probably could, you know.
I should have mentioned at the beginning to kind of glanced over the investor's title piece. But for those that don't know, investor's title is a very large, very prominent player in the title insurance market and the 1031 exchange market, right? And I mean, how long has investor's title been in business for?
So investors title has been in business for over 50 years. And our exchange corporation, our department that is solely dedicated to 1031s, was started in 1988.
Wow.
So we have many years of experience. We have 3 attorneys on staff who serve as exchange counsel 18 people on the team altogether, and 6 of us hold a specific designation, and it is the only one that you can achieve in the 1031 world, and that is a certified exchange specialist designation. There's a lot of parameters you need to meet to actually qualify for taking the exam. It is an exhausting 125 question exam that you have to pass. And I think right now there's less than 200 in the US.
Oh,
in
wow.
Investors Title, we have 6 on staff. So that speaks a lot to our desire to be educated, to keep up with what's going on, the trends, our promise and desire to be as steadfast as we can with security of funds and finding out what's happening out in the marketplace, and just our dedication to knowledge.
If and we'll put this in the notes too below the video, but if somebody wants to contact Investors Title to talk about this, what's the best way to get a hold of you guys?
So they can call me directly, Chris, and I would love that, whether call, email, or text. And certainly I'll make sure everybody has that info, but they can call me directly at 984-484-8685.
Okay.
And since real estate and investing is just 8 to 5 Monday through Friday, I also answer my phone and text on Saturdays and Sundays if needed, because I know there's a lot of questions and things happen in off hours and outside of the Monday through Friday schedule. So anything that we can do to be of help, that's what we're here for.
Great. Fantastic. Matt Linville, thank you so much for your time. And I look forward to working with you many years to come, my friend.
Same here, Chris. I really appreciate the time and the opportunity to share.
Enjoy vacation.
Thank you, sir. We will.
Happy Memorial Day. Take care.
Have a Memorial Day.
Bye-bye.